How does April's PCE change the Fed's rate decision in June?
So the April PCE is the Personal Consumption Expenditure Index. This is a measure of inflation. It is a different basket of goods from CPI. Lots of differences as to how they calculate that inflation. It is the favored measure for the Federal Reserve. And I can't tell you how many articles I read saying, oh, they got to go from 9%, which is where CPI was. PCE never got there. You got to go from 9% down to 2. Totally inaccurate. Actually have to take PCE and take out food and energy to figure out what's called core PCE. And that's what they got to get down to 2. And so PCE went up a little bit in April. Went from 4.63% on the core to 4.7% in April. And so, and that's not good. It's not terrible. Essentially, it's been at the same level for quite a few months.
Yeah,
Right?
even just regular PCE is below core, which is kind of unusual to
Yeah.
have food and energy to be kind of in a deflation.
Yeah, you're seeing some deflationary pressure, especially energy.
Yeah.
But even in the food arena, partly because food was going at 10 to 15%, so it's just starting to slow down some. But what's happening is that, again, we've seen the futures market as of the beginning of this month say 99% chance the Fed is not going to be raising rates in June. June 13th, 14th is the meeting, right? And now we're at a 66% chance that the Fed will be raising rates, right? That's the bet right now. And so that has a lot to do with, I think, what's coming out from these inflation numbers from PCE. So I think there's some pressure on the Fed to actually raise rates again, which would be a surprise to the market to a certain degree. However, at the same time, the Fed governors have come out and talked about this debt ceiling issue. So if the debt ceiling is not resolved by the 13th and 14th, they will not be raising rates, in my opinion.
Yeah,
Right.
and if you look into like July too, they're
Right.
saying we were predicting us going down
Yes.
actually.
Yeah. That was predicting a quarter point cut in July. I remember at the beginning of May, that was maybe a 50-50 chance.
Yeah, and now it's looking at is there going to be another increase too?
Yeah. Yeah, exactly. And it's just not unusual. Inflation can be quite sticky because you get these kind of spirals, inflation's there and then employees need more money, to buy the same things. And so they get higher pay or ask for higher pay. And then, of course, that pay gets passed on to, higher cost of goods up to a point. You can't continuously raise prices, but the economy's pretty good. The pent-up demand's there. People are willing to spend the money. So that's, so far, the pass-through has been working. They've been passing through those costs to higher higher prices for goods and services. And so, eventually that stops and starts to compress the earnings, because if companies can't raise their prices, but their costs are going up, they're going to make less. And that has been the whole fear of this downturn mentality that's happened, and that, of course, just hasn't happened yet. So I think that it does have an impact. It's going to be more of the story once we get here. Let's assume the debt ceiling is solved. That will take that off the table for the June 13th, 14th, Fed meeting, and they'll just be able to focus on inflation. And I wouldn't be surprised to see a rate increase to get us to basically 5.25% from 5% on the Fed funds rate, just because they're not seeing as much motion to the downside, and they can push a bit more because the job market is still really, really good.
Yeah.
And that's their other. They have a dual mandate: low inflation, they pick 2%, and full employment. Right?
Yeah.
We have full employment, that's for sure, and so they can push on the rate increases. The danger is always that they raise rates today and don't see an impact in the market for 3 to 18 months, in the economy. So, that's where everybody worries, because the Fed historically over raises rates. And that's because of this lag. It's very, very difficult to tell what to do. They're literally might be responding to a report that just came out today on the 26th of May, that they're going to make a change for June 13th and 14th. That might not have an impact to the economy for quite some time, even next year. So That's why they generally overraise rates. It's
Yeah,
because it's
you
very
gotta think about
difficult.
it. They're making a decision based on an April report in June, and so
Yeah.
there's also that lag on that data.
Yeah, exactly. I mean, things could have softened between then. I mean, they do have probably some more foresight to see things than we do, but nonetheless, historically, they have overraised rates. So, and even historically, done the opposite. In the pandemic, they didn't raise rates fast enough in the end. That's for sure.